there's going to be an opportunity cost there since other semiconductor businesses are very healthy financially, in no need of assistance, building these ambitious fab projects around the globe.
Hey y'all, welcome back to Chipstock Investor. Today we're going to be talking about Intel's glorious rebound.
Yeah. A few years ago, I controversially called Intel the IBM of the semiconductor industry, which is really unfair because IBM is now making a pretty good comeback, as we've written about a number of times the last 2 years. But maybe let's say where IBM was at in the 2010s, Intel is most definitely at a similar point in its life stage here in the 2020s.
Absolutely. We have a new bull market going on right now, and that is fueled by accelerated computing infrastructure. And Intel has definitely underperformed both the market overall as well as other leading chip stocks. At a stock price of around $38 as of April 8th, 2024, Intel is down 20% year to date, up 20% trailing 12 months. But just for reference, SOXX ETF is up almost 16% year to date and 60%, 60 in the last trailing 12 months. So you can see that Intel has underperformed significantly so far this year. Today, we're going to focus on some comments and disclosures they made this last week and their great turnaround that they have planned. Is it going to be as they say? Is the stock a buy? Or are we staying clear of Intel stock? We'll discuss all of that on today's episode of Chipstock Investor.
Maybe just a little bit of background information first for those that maybe don't know. You've probably heard from just about every mainstream media news station, favorite social media, investing circles, or wherever you catch up on gossip in real life. You've probably heard Intel is trying to mount a comeback and positioning itself as some sort of US national hero in chip manufacturing. Why? The short story, after the chip shortages during the pandemic, paired with mounting tensions between the US and China, the US is looking to bring back some semi manufacturing onto its home turf. Additionally, there's a lot of worry over an invasion of Taiwan by China and what that could mean for Taiwan semi manufacturing. Ticker symbol TSM, far and away the largest third party chip manufacturer that makes chips for everyone from NVIDIA to AMD to Apple to, as you'll see in a slide a little bit later, also a little bit of Intel's manufacturing as well. Something like 90% of the most advanced chip making is handled by TSMC, though that's kind of a hard metric to measure because what exactly constitutes advanced? All semiconductor manufacturing is an incredibly complicated process. At any rate, as the old political and business mantra goes, never let a good crisis go to waste. So, Intel, here we go.
Intel of the past was an IDM or integrated device manufacturer. You can see that on our semiconductor flow over there on the left. But Intel is trying to branch out into a different type of business model. Intel has now split the business into two separate entities, Intel products being part of the fabless chip designer portion of the industry, and then Intel Foundry services that chip fab and contract manufacture.
This is probably reminiscent to something similar to AMD's story after the great financial crisis of 08, 09. They split into the fabless chip designer, AMD, that we know them as today, and their what used to be their internal manufacturing business, Global Foundries, is now a third-party contract manufacturer that handles wafer fabrication for fabless companies like AMD. So Intel's sort of going the same route. These are actually just two separate segments that are still under the same Intel umbrella because the Intel Foundry is ultimately still primarily earning revenue from Intel products, the fabless chip design company. So not a hard split, but two separate financial reporting segments now.
Intel has extensive manufacturing capabilities in the US already, which makes it a great candidate for this onshoring of lost chip fab market share. But after a couple decades of mismanagement and missing several secular growth trends, Intel is now in a world of hurt. Take a look at the 2023 financial segment results that Intel just peeled back the veil on. In the center of this chart that Intel provided under Intel Foundry, you can see a $7 billion loss in 2023 for Intel in their Foundry services segment. Now, Nick, is this a new problem that they have on their hands?
No, it's not a new problem. And because they're now creating that hard financial split between the products, the fabless chip designer, and Foundry, the actual manufacturing segment, they went back and redid their financials for 2021, 2022, and of course, 2023 in the last slide. We have this pulled up from the SEC financial filings. And you can absolutely see here that Intel Foundry, not a new problem. Even during the last semiconductor industry boom in 2021 and 2022, when everyone was still purchasing PCs and laptops and such because they were working from home, that manufacturing segment still generating at least a $5 billion operating loss in each of those 2 years before the current downturn for Intel, which we're just now coming out of, creating an especially egregious hit to that manufacturing business, almost $7 billion in operating losses last year. So again, not a new problem. We've known Intel was an industry underperformer for years, and now the investing community can see exactly where that underperformance is coming from. For many years, this Intel IDM strategy, where they had everything combined, the products design team and the manufacturing segment sort of as a cohesive whole, it seems like it was the manufacturing segment that was the weight that was holding Intel back, at least under these new reporting structures. And this is the worst part, Kasey. So Intel's been talking a lot about regaining manufacturing technology leadership from TSMC since Pat Gelsinger took over as CEO a few years ago. And this is what really had the market feeling pretty glum after this update. They said that the Foundry is now on a path to reaching break even, not generating a loss anymore. But just like they did last June when we covered Intel's, first announcement that they were going to create a bit of a break between manufacturing and product design, they were very vague in the timeline. Here we have another slide again where they have basically deleted the X and Y axis data points from their charts. We don't have an actual timeline until this Foundry third-party manufacturer actually reaches break even. On the actual call for this presentation, Gelsinger said, in a few years, Foundry should reach break even. And a little bit of context added to this one, longer term, Foundry expected to be a mid 20% operating profit margin segment by 2030, 5 to 6 years down the road from now. On a consolidated basis, when you add the two segments together, again, product design and manufacturing, operating margins expected to be in the mid 20% range within the next 3 years or so, let's say. You can see that at the bottom of this chart, Intel consolidated, OM means operating margin, 23 to 28%. And then long-term, 2030 target, they're looking at, on a consolidated basis, 40% operating margin. So Intel Foundry being the lower profit margin business of the two between product design and manufacturing, but still the long-term target is expected to be quite good. However, without a specific timeline on when Foundry actually, starts contributing versus being, a bit of dead weight for Intel overall, the market was not happy because the timing of your profitability most definitely matters when you're deciding where to invest capital.
All of these financials that you've just discussed, Nick, help explain why Intel has been taking various assets and subsidiaries to the pawn shop, as I like to say. We talked about this in a video regarding their re-IPO of Mobileye. And one of their latest is the revival of the Altera brand name. And that's the FPGA business that Intel acquired back in 2015. And that portion of the business competes with AMD's Xilinx and Lattice Semiconductor. For the record, we're not worried about Altera threatening Lattice or AMD, at least not at the moment. But Intel is planning another spinoff with Altera by raising more cash by doing an IPO, much like it did with that company's that self-driving car chip designer Mobileye, which re-IPO'd in 2022.
Yeah, absolutely, Kasey. Intel is in need of a lot of cash. And so Altera, simply just another way for them to raise perhaps a few extra $1 billion in cash. It sounds like a lot of money. In Intel's own description now, finally, if they're explaining to investors that maybe don't know, building out their manufacturing capability to catch up to TSMC technologically is going to cost tens of billions of dollars each fab. You can see this here as we enter the high NA EUV era. That's the high NA EUV in reference to ASML's latest and greatest technological equipment, technological marvels. You can catch that in our semiconductor manufacturing and chip packaging equipment index video. Link to that here in the video and in the description below. Intel has multiple of these fabs that they're trying to build out, each of them costing more than $20 billion a pop. They need a ton of cash.
Intel has managed to scrounge up quite a bit of funding from the US and Europe via the CHIPS Act in both of those respective continents, not to mention the other deals that they have cut with Israel and other countries. This chart, Intel capital at work, but most of that capital actually is coming from an external source. The deal in Arizona was worth $30 billion, and 51% of that to come from Intel and 49% of it to come from Brookfield, the infrastructure investor.
Yeah, granted, Kasey, to be totally fair, Intel is going to shell out ample amounts of its own money, but this line may be slightly offensive to some investors for them to say that, it's Intel's smart capital in action. Very much a 50-50 split at best across the board here from Intel's contribution to these manufacturing projects and external capital. So Intel is not in control of its own destiny at this point. It is, as you said, scrounging up a lot of cash from third-party sources. And it's an ambitious project. And I think the main takeaway here is it is perfectly acceptable to root for a company's success, but simultaneously pass on owning the stock itself. This is why I guess I've kind of been off and on over the last couple of years encouraged by Intel's progress on their technological manufacturing progress. But then also right on the heels of that, I get kind of annoyed at Intel's constant PR work that likes to sidestep some of the nitty gritty of the situation that they're in. Because Intel, it keeps trumpeting their return to technological leadership and the massive opportunity there is competing against TSMC. But now that we have more specifics on the actual financials and how ugly that manufacturing business has been allowed to get, 3 years now, Gelsinger has been back talking about this, and we're only just now seeing the hole that Intel Foundry is in. It's starting to make this, quote, smart allocation of capital more like something of a bailout of a failing business than it is a funding for a healthy and growing business with great opportunity ahead of it.
At the beginning of the video, Nick, you mentioned that it's estimated that TSMC produces about 90% of the most advanced chips. And catching up with a company like TSMC is going to take many billions of dollars, many fabs, and many years to complete. And while Intel is constructing these fabs, meanwhile, the generative AI growth cycle and accelerated computing infrastructure secular growth trend rages on. So TSMC is definitely still in the lead and will be for many years. And Intel is not going to beat them in this growth cycle.
And as we've said in the past, sure, you can bet on an Intel rebound, but there's opportunity costs involved with that because you just said it, Kasey. It's going to take billions of dollars. Intel's getting help with that to construct these fabs. That's fine. But also years, many years to get those things up and running. You don't just build a fab and in a year or two, you have it, cranking out wafers and packaged chips ready to go. It might be 3 years before the fab is complete. And then maybe another year or so getting the fab running up at full capacity. And so along the way, you have a company like TSMC already in the midst of a downturn, coming out of a semiconductor industry downturn, still generating north of 40% operating margin, the very target Intel hopes to hit by the end of this decade. So the opportunity cost in investing in Intel, if you're an investor and you remove all of the political rationale for why you might want to invest in Intel, the geopolitical tensions between China and Taiwan and the US and whatever, if you remove all of that, it's just simply looking at your personal allocation in your portfolio. This is what you're missing out on if you bet on an Intel rebound. Kasey, this also isn't even to mention the fact that we have some doubts about Intel's model of continuing to run its fabless products segment alongside this foundry that simultaneously services Intel's products, but also goes after other third-party fabless chip designers. There's actually a company out there already that has made a pretty successful go of it. A little tiny company in South Korea called Samsung already has a model like this of sorts. Granted, it's not totally apples to apples because Samsung Electronics is a giant that also produces its own finished products. But you can see here, I hope this makes the point that even in a pretty decent year, Samsung generating somewhere in the mid to high teens percentage operating margin. I kind of have my doubts that Intel on a consolidated basis is going to reach 40% operating margin with a business model like this by the end of this decade.
Let's talk about the stock price and the valuation for Intel currently. Right now, Intel is around $38 per share, market cap of $165 billion, adjusted earnings per share of $1.05 in fiscal year 2023, which is down 37% from 2022. What is the market assuming for this company at the current valuation?
Yeah, that's a good question. And I think these assumptions we're about to show you help explain why the stock sold off so hard after this Intel Foundry financial update here in early April. Because to get to a fair value of $38 per share, market cap of $165 billion, if we do a reverse discounted cash flow on the adjusted earnings per share, we have a couple of assumptions penciled in here to get us to a fair value. And we're looking at about 25% adjusted earnings per share growth for the next 2 years, and then a 6% terminal growth rate thereafter into perpetuity, and a discount rate of about 10%. If you plug in those assumptions into a discounted cash flow calculator, that's what gets you to $38 per share as a fair value. It's not a really, really high bar to clear, but it's certainly not a low bar either. So what was the market expecting when Intel stock had, surpassed $50 per share in the recent couple of months? There seemed to be a lot of hype about Intel making this glorious comeback without ever facing the reality of what it was going to cost and how long it was going to cost to get those fabs up and running again. This is a tough business to get on board with. And if investors are being honest with themselves and you peel back all of the PR talk about regaining technological leadership and so on and so forth, Intel still has a very long and difficult battle ahead of it just to get that foundry business back to break even. And along the way, there's a lot of question marks about how profitable the business overall will actually be once it gets there.
As for us, we're not buying the financial targets for Intel. TSMC is already there at an operating profit margin of over 40% right now. As we've mentioned in the past, we're still looking for a hard split between Intel Products, which is the fabless designer, and Intel Foundry, a third-party manufacturer like TSMC or AMD's old manufacturing business, Global Foundries, before we're even remotely interested in investing in Intel.
Yeah. And in the meantime, just to reiterate this very important point, over allocating your portfolio to Intel requires a trade off. And we have a more precise timeline until payoff. And that precise timeline is right now. We're getting financial payoff right now. We don't know when the financial payoff will be for Intel. So we see lots of better places to invest. For example, the fab equipment providers. Again, take a look at our last video on that sub-industry of the semiconductor manufacturing supply chain. And then also we did that video at the end of January, stocks that we like better than Intel stock if you want to invest in an Intel rebound. Spoiler alert, it has everything to do with those fab equipment providers, which will gobble up most of those government funding packages for Intel.
Yep, got to fill those foundries with chip making equipment. All right, that's a wrap on today's episode of Chip Stock Investor. We still have much more coming your way this week. Earnings season is starting today with Air Test Systems for us. So we will make sure we have a video and analysis out for you after that earnings call later this week. If you haven't yet, please hit the subscribe button and check out our membership here on YouTube or over on our Ko-fi shop. That'll get you links to all of our manuals that we have published and Discord access. See you again very soon at Chip Stock Investor.